Everybody, and welcome to this webinar on the Corporate Sustainability Reporting Directive. Thank you all for joining. We have a large number today, so we're delighted to have so many of our clients and other interested organizations joining us for this webinar. My name is Liam McKenna. I'm a partner with the Mazars consulting team here in Dublin. I have about 25 years of experience working in financial services and subsequently in professional services. And I've been focused on the sustainability topic and sustainability strategies, a lot of climate-related projects since 2019. And I suppose more recently in the last 6 months or a year, involved in this readiness for CSRD, which is becoming more and more an important topic for our clients and for ourselves here as auditors within Mazars. I'm joined today by Laura Angelin, who's also an Irish partner in Dublin. Laura works on our assurance, audit and assurance team, and she's leading the rollout of our CSRD preparation. Obviously, we have the requirement to train 500 auditors in how to provide assurance over CSRD reporting, and it's a very large job for us. We have, Laura participates in our global network in preparing for this. And Laura's also on some Irish working groups within the industry to, I suppose, identify and standardize some of the approaches to CSRD and the documentation required to provide assurance. And we're also joined today by Emmanuel Terry, who's a partner in our French firm. Emmanuel is leading our global CSRD projects and teams. And he's also the lead partner on a number of our multinational clients that are engaging us on CSRD. And so, you know, he's probably got a breadth of experience across quite a large number of organizations of different scale and complexity. So within the webinar today, we're going to cover off a number of items. First off, just a little bit of the background around CSRD and the drivers for CSRD. Then get into the scoping. I think we get a lot of questions as to, you know, who is in scope and when are they in scope? And, you know, particularly, I suppose, organizations are thinking about that from their own context. What are the ESRS? And these are the standards which are driving a lot of what we call the materiality assessment and the considerations of what you need to report on. Preparing then, so, you know, how do we actually get from an organization which is not currently reporting on CSRD or even NFRD with a precursor and get them to a point where they're going to be delivering a robust CSRD sustainability report. And Laura will then cover off a little bit just around assurance and what the auditors would expect. And I suppose the distinction between what's going to be required for initially for CSRD versus what is required for financial reporting, because there is a lower level of assurance required, which will be covered off. So just, I suppose, to introduce it, you know, the EU Green Deal has been around for a few years now. Everybody is probably familiar with it to some extent, and they can see that it's driving a lot of change. You know, here in Ireland, we have the Climate Action Plan from the government, which is coming from the Green Deal, and a lot of policy and a lot of business investment is linked to the requirement to make very significant changes to how we operate and how sustainable we are as individuals, as families, and as organizations, in order to get to the type of world we want to be in a couple of decades' time. And so the CSRD is about bringing, I suppose, transparency to that process. If we look at the difference between the non-financial reporting directive, and actually even the naming of that is interesting. We used to talk about sustainability as being not something else. It's not financial, but now it's clearly sustainability is something positive in its own right that we need to talk about and address. And the NFRD has been in place since 2014. It suffered from a number of, I suppose, issues which are now addressed in the CSRD. The first is it was quite narrow. It was very large organizations only that had to report on the NFRD. There was no mandatory prescriptive reporting requirements. It was quite vague, and it allowed for organizations to, I suppose, report what they wanted to report, maybe ignore other things, not apply the level of rigor and discipline necessarily required to be able to compare organizations. And to use the mandatory use of limited assurance. So actually to have some auditors come in and validate it. One thing to point out about the CSRD is that it's not you don't need to be a sustainable organization to be compliant with the CSRD. What you need to do is identify your material aspects and be clear on where you stand on those and what your plans are around those. If you turn out to be a not unsustainable organization in the context of this type of language, you're still fully compliant if you report. I suppose the driver or the sense is that you will suffer from a lack of clients and customers not wanting to deal with you. Access to debt and capital will become much more troublesome, and staff may not want to work for you. So really, and the CSRD is not in itself going to result in more sustainable organizations, but the transparency of it may do so, hopefully. I think, actually, Emmanuel, we sometimes add a fifth item to this. Do you want to maybe comment on this slide?
That's very right, what you just said. So we're talking mostly about transparency with CSRD. So you have to say what you're doing. That's a key thing. But the other thing is also there is one fifth item that we sometimes add to that list of differences to the NFRD, which is the fact that you need to disclose as well which are your objectives, what are your transition plans, what are your adaptation plans. And that is not to tell you what you should be doing, but you need to be clear about what you want to do. And that's quite important because also from a communication point of view, you are making a statement as a company. And for instance, you need to state whether or not your transition plan is aligned with the Paris Agreement of 2015 and the 1.5 degree. And obviously making a statement that your transition plan is far from being aligned with the Paris Agreement in itself is creating a sense of obligation. So again, there is no formal obligation. It's all about transparency, but through transparency comes also some kind of pressure because you have to state what are your objectives and whether or not you are aligned with the Paris Agreement of 2015. Same as with the taxonomy reporting, you need to say if you are aligned with the EU sustainability development goals. So typically your percentage of alignment is something that is revealing as well about the values and the strategy of the company. So again, transparency, but giving you a little bit of a direction and making sure that you state whether or not you align with the objectives of the EU.
Thank you. So, I suppose that what organizations need to be clear on is getting to a CSRD operating environment is a complex, and we'll get into it in a bit more detail later on, but it's a very challenging transition to make, especially for organizations that haven't been reporting on NFRD, so maybe are starting from a quite immature level. So it's about, you need to have the data, you need to monitor the quality of the data, you need to have an internal control system to provide assurance over how much confidence you can have in that data, and that's to produce the report. And then you need to get into the process of actually delivering the assurance, bringing through the board processes, reporting it out. And look, ultimately, maybe we might get Emmanuel to talk about it later, but we're seeing a transition possibly from a head of sustainability owning these documents prior to CSRD to possibly others in more the financial reporting function getting ownership. But I'm not going to jump into that now, but maybe we'll come back to it at the end. So that's, I suppose, a little bit of the background to it. Laura now is just going to talk about the scoping and some more detail on the ESRS materiality.
Thanks, Liam. So I suppose as we've heard it already in Liam's section there, the Corporate Sustainability Reporting Directive is a critical piece of legislation, and it can be seen as a game changer with regard to sustainability reporting, as it basically extends the requirements across all sectors and to a larger volume of organizations. The application of CSRD is phased around 4 different groups of organizations, and so around 4 different timing periods for adoption, and this is presented on the slide there. The first group of entities in scope are the large listed companies with more than 500 employees. So these are the organizations that are already in scope for reporting certain sustainability information under NFRD. They'll be more mature, ESG and sustainability reporting, and they are expected to report their first CSRD report in 2025, reporting on 2024 data. The second group then will include large EU companies, being those listed and non-listed, that meet two of the three criteria that we present here on the slides, and their CSRD report will have to be published in 2026, reporting on the 2025 data. Then from 2027, reporting on the 2026 data, other listed entities will be added into the scope. And again, same principle, entities that are meeting two of the three criteria presented on the green box this time will be in scope. Finally, certain non-EU entities or groups will also fall in scope for CSRD at a later stage. That will be from 2029, reporting on their 2028 data. I won't go into too much detail today in terms of group considerations under CSRD. There's a number of elements that come into play. You will have a link in the slides that we distribute after the webinar to a publication on our website that actually has helpful decision trees and a number of case studies that cover a number of scenarios in terms of group structure that could be helpful if this is of interest to you. But to be very brief, non-EU entities or groups that are generating more than 150 million turnover in the EU will be in scope, as well as groups which have at least one subsidiary that is considered as a large or listed company in Europe will be in scope. Similar than for financial reporting and consolidation purposes, the CSRD does allow for subsidiary exemption. So if an entity, an entity can be exempt for presenting at individual level a sustainability report if they are consolidated in a group which publish at a consolidated level a CSRD compliant report.
And Laura, just maybe a point I should have made was just around there is still some uncertainty in the sense that the Irish legislation has not yet been passed. Is that correct?
Yes, correct. So the CSRD is at European level. There's a requirement then as for any directive to be transposed into Irish law. The deadline for that is early July 2024. So this is in progress. So until it's done, we can always expect some changes or some elements that may evolve. And maybe to add on that, the threshold that you see here on the slides, if you have looked at that even a month ago, they have changed very recently, mid-October. There has been an amendment at EU level and the threshold have been increased by 25%. And this is to reflect for the current inflationary environment. So things are evolving, but this is where we are at the moment. So we have discussed now who will be in scope, and in the next section, I will cover what are the actual requirements in terms of what needs to be disclosed. So the European Sustainability Reporting Standard, the ESRS, that's the reporting framework that's being implemented for sustainability reporting in the EU. The same way that we have the IFRS or the Irish GAAP FRS 102 for financial reporting, a set of standards, a framework, has been adopted officially now since July 2023 by the European Commission, and that's dedicated to reporting on the CSRD. When the CSRD directive will be transposed into Irish law, then the ESRS will then also be officially enforced in Ireland. So we commonly refer to these standards as the set 1 of standards. The set 2 will be made of a number of sector-specific standards and will complement the existing requirements under the set 1. At the moment, I think it's about 40 sectors that have been identified by the EU that are under review, and the draft of those sector-specific standards is ongoing. So there's a bit of time before these new standards will be effectively added into the scope. And also to note that very recently, the European Commission has revised their expected timeline, pushing the deadline by 2 years. So it's an evolving environment. but at the moment, definitely the focus is on this set one of standard. So as it currently stands, the ESRS are made of 12 standards. If we can stay on the previous slide, yeah, please. There's 2 general standards and 10 topical ones that are covering elements related to your E, environment, your S, social, and your G, governance. So when you look at this list of standards, there's a broad range of sustainability-related topics, and this appears very clearly here. In terms of structure, and to bring a little bit of the language that are used in the standards, the ESRS are composed of what we call disclosures requirements, 82 in total across the 12 standards. And each disclosure requirement is then broken down into data points, which are really at a very granular level what is actually required to be disclosed in relation to sustainability matters. We're talking about more than 1,000 data points across the ESRS. So reflecting on what we've already seen disclosed in organization in Ireland, and sustainability disclosures that we already see in financial statements, for example, climate change related disclosures are often captured to a good extent within the director's report. We see as well, we tend to see disclosures related to diversity and inclusion, and that seems to be captured to a certain extent. We have the gender pay gap requirement in Ireland, and that's supporting this. But really, when you look at the other topics there, there's a number there's a number of new elements that are involved here, and that needs to be considered and assessed sooner than later. It is an extensive scope in terms of sustainability information that are captured under CSRD, and we can't understate that. But as part of the CSRD journey when implementing CSRD, it's expected that in the first place, entities will be able to eliminate naturally a number of these requirements because they'll be just not applicable, not relevant to the entity. So when you will actually start the work and the analysis in terms of what's relevant to your organization, you will start from a preliminary list of relevant topics, and that won't be the full 1,000 plus data points that I've mentioned there. Then embedded into the ESRS 1 standard is a very prescriptive methodology to conduct a double materiality assessment on those relevant topics. And that will ultimately give you a list of material topics. So you start with everything that's there. Naturally, you remove what is not relevant, not applicable. After that, you do your materiality assessment, which will allow you to eliminate a number of other aspects, and you end up with a list of material topics, and these are the ones that will need to be reported on. So I'm conscious I want to keep time for question there. So I'll just refer to a document that publication we have on our website on ESRS that go into a bit more detail in terms of this double materiality assessment, in terms of the content, the structure, and a bit more in terms of the spirit and what we're trying to achieve across those ESRS. I'll take a couple of minutes just to focus on double materiality assessment. It's a new concept, completely new concept brought in by the CSRD, and it will require companies to disclose information on sustainability matters under that double materiality principle. So a sustainability matter will be material if it meets criteria of either being material for impact materiality and financial materiality, or both. So this concept of double materiality is introducing the impact materiality and the financial materiality. So when you conduct a double materiality assessment, you have to take into account not only the impact that the entity have on their people, the environment, the communities, but also how the entity itself is impacted by external factors. This assessment of materiality and I suppose focusing on the impact materiality will include different elements. So actual and potential impact will need to be considered, positive and negative impact, short term, medium term, longer term. So it's, as I was saying, there's a very prescriptive methodology that's set up there, and a number of elements that needs to be considered when assessing the materiality and the impact one. When it comes to the financial materiality, this is probably closer to what we're used to use on the financial reporting side to assess the effect of sustainability matters on the entity's cash flow, development, performance, cost of capital, access to finance. If we can move on to the last slide, Liam, please. There's a last point that I wanted to make in respect of the ESRS and really what's expected from the companies under the standard. So CSRD brings in the necessity to take into account the value chain of the entity when considering what are the material topics applicable to that entity and preparing the reporting. So the idea behind that is that the environmental footprint of a specific organization is impacted by both the upstream and the downstream value chain participant, as well as the entity itself. So as to the entity itself, and that's what we present there on the slide, the sustainability reporting should cover the IROs. IROs is a concept included in CSRD. It refers to your impact, your risk, your opportunities. So when you have identified a sustainability matter relevant to you, this sustainability matter may have impact, may have risks, may have opportunities. You have to disclose policy, target, actions. Emmanuel referred to that earlier, and also include a number of indicators and metrics. On the CSRD, we estimate that approximately a third of the data points are quantitative and 2/3 are qualitative. When it comes to the value chain, the IROs, the policy, the targets, the actions will also need to be disclosed as far as they are relevant to the entity's activities. But then in terms of quantitative disclosure, it will be mainly the GHG emission disclosures that will be expected. So I don't want to take, I suppose, too much of a shortcut here, but it's expected that sustainability disclosures in respect of the value chain will be mainly quantitative in nature. The spirit of CSRD is to understand and present the environmental footprint of the organization, including its ecosystem. But in terms of quantification, this is really targeted to the entity-specific metrics. Emmanuel, can I invite you there if you want to share any insight or add anything to that?
Oh, definitely. I think it's something to really keep in mind that when we talk about precise data, when we talk about indicators and KPIs, for the value chain, this is limited more or less to the greenhouse gas emissions. So basically, the biodiversity KPIs or other kind of KPIs or even social KPIs may not be relevant or may not be required for you to publish. And that's also taking into account the fact that basically it's pretty tough to get that information, right? So we'll be talking about data later on, but at the end of the day, there is a point of making your information more transparent, more relevant. And for that, you need to make sure that the information is available. Obviously, for GHG emissions, this is something that is possible because the carbon footprint now is a concept that is relatively widely used, at least in Europe. And second, there are also some ways through proxies, through estimates, to calculate the carbon footprint of your value chain. So that's basically the only area where there will be a strong requirement for data. For the rest, it's going to be more a qualitative kind of information that will be required.
Thanks, Emmanuel. So we've clarified what is CSRD, who is in scope. We've introduced the reporting framework. So Emmanuel, if that's okay, I'll hand over to you again to cover some practical steps as to how we can prepare for CSRD.
Yeah, thank you, Laura. So I'm leading our CSRD task force globally at Mazars. So I have a chance to see how CSRD projects are actually implemented from Ireland to Poland, if we just look at the EU. But in fact, we are also doing CSRD projects in the US or even in Asia for Asian clients, typically with subsidiaries in the EU. What we observe, we see two big phases. Basically, the first phase is with analysis and planning, and the second phase is about implementation. At the end of the day, you'll tell me, and no big deal. That's kind of standard ways of conducting any transformation project, and that's true. However, what we need to keep in mind is that this is a transformation project which is not only for reporting, but that will also have some impact in terms of operations, in terms of strategy. So one key message maybe from that slide, beyond the fact that you have those two phases that need to be clearly identified, one key message is that a CSRD readiness project requires the involvement of many different departments. And you need to really embark people from the beginning with the same vision, with the same view on what are the objectives of the project and how to get there. You'll need people from the IT department. You'll need people from the finance department, HR, operations, and so on and so forth, internal audit. Plenty of people will be involved because this is really an all-encompassing project. Because this is so large and wide-reaching, that's why you always need to start with making sure that you have onboarded your top leadership. What we are doing right now, we're doing plenty of presentations to the board, audit committee, but also to the board of our clients, and as well to the executive committee of our clients. And that's very important because then they understand and they are clear about what are the objectives of the project, but also they understand the implications of CSRD, implications with regards to their clients, implications with regards to potential financing issues. The banks will cut the flow of financing if there is no CSRD report that is compliant, and also at some point of time if it's not in the right direction. Let's be clear about that. So really there are some strategic issues that the top management needs to be aware about, and that's why you always need to make sure you have the sponsoring at the right level. Then, as Laura was explaining, you move into double materiality assessment to know what you're going to disclose about, what is significant for you, what is really something materials that you need to talk about. And you move on with the kind of the traditional way of conducting projects with a gap analysis, checking also taxonomy, which is always a specific thing. And you need to have your compliance roadmap. What we observe is that this first phase will last between 2 and 3 months. Usually, because you need a lot of back and forth, making sure you have the right consultations and so on and so forth, but you need at least 3 months to put together your compliance roadmap. And then you have your implementation phase. And your implementation phase, it depends on your maturity. If you already have a strong NFRD kind of reporting or ESG reports, then that a lot of things will be relatively easy because you have already people who know what they're talking about, who know, who have put in place this kind of reporting processes, and you will not start from scratch. If you have nothing, obviously, you're not that mature in terms of ESG reporting, and it's going to be a much longer process. So for phase 2, a mature organization will take about 12 months maybe to get there. Operations company that has not yet really started in terms of ESG reporting may need 18 months. You have several pieces. Just let me talk about 2 of them. One is internal control environment. Obviously, that's a new requirement from CSRD to align the quality of the ESG reporting with the quality of the financial information. That's a clear statement, a clear objective of the EU to make sure that both information, ESG and financial information, are with the same quality level. That's why we have audit, right? That is being introduced as a mandatory step for CSRD. But for that, and that's also specifically stated in the CSRD, you also need to make sure you have an internal control environment. And by the way, in 2028, when the entire EU is moving towards reasonable assurance, well, you need to have a reliable internal control environment for the auditor to be able to issue its opinion. So just one reminder, make sure you have the internal control environment that will allow you to deliver qualitative data, but also that will allow you to monitor your KPIs, because it's not only about reporting, it's also about making improvements. Let's be very clear. The first reporting, you're going to discover a number of things, and you'll have some questions from the top management. Why do we have this? Why do we have that? And so on. Why are we so bad compared to the competition? So there will be improvement plans that will be launched, and without internal control, you won't be able to follow up on that. Second point I want second module, if you want, that I want to point out is a transition plan. You need to disclose a transition plan. So there are some transitory provisions in the CSRD or in the ESRS, but you need to have a transition plan. And most companies, they won't be able to avoid having a transition plan on E1, which is about climate change, because somehow climate change, that's something that's relevant for all companies, right? So you need to make sure that you have a transition plan. The transition plan is something that's quite technical. You need to put it in place with being compliant with SBTi, which is a standard to put together the carbon accounting, if you want. And those transition plans will require you to make sure you have either the internal experts working on it, or that you have also the right people assist you in putting them together, from a technical point of view, but also from a compliance point of view, because the transition plans need to, according to the CSRD, to comply with a number of specific steps. So those are the key messages I wanted to share with you, is really making sure you have the right sponsoring, making sure you are onboarding all the different departments which are relevant for this kind of project, and focus your attention on key issues that need to be addressed early on if you are not a mature ESG reporting mature company like the transition plans.
Thank you, Emmanuel. So maybe one of the aspects of phase one that Emmanuel highlighted, and obviously Laura has also spoken about it, which is relatively new to most organizations, is the double materiality analysis. And Laura pointed out about the impact on financial materiality and taking both lenses. But we get a lot of questions around this, and it's probably within phase one, the aspect that takes the most amount of time in order to get it right, because ultimately, if you don't report on the material topics, the correct material topics, you're not going to be your auditors are going to have challenges around that when they come to provide you with limited assurance. So maybe the first thing about this is it requires quite a lot of stakeholder engagement. Like at the start of the materiality assessment, you're going to draw a value chain, which would have upstream and downstream organizations in your value chain, and also the stakeholders. And if your stakeholders are, for example, investment organizations, they're also going to have to report on the SFDR. So, they're going to be demanding certain things from you and require certain data. So understanding who it is your stakeholder, who is going to use this report and for what purposes in the future, is key to making sure that you engage the right organizations, you engage the right stakeholder groups in order to assess your materiality and come to a conclusion on it. One of the, I suppose, the question then becomes, how do you gather all of the data? An organization, an insurance organization, for example, is going, okay, well, if we want to assess our materiality, first off, we want to make sure we're not out of line with everybody else, but also how do we gather all of the information about upstream and downstream and what our stakeholders believe? So there are a number of ways. First off, we need to do a benchmarking exercise whenever you're starting the materiality assessment. And if you look, actually, you can look yourselves, anybody, at the SASB database on benchmarking data, and it has, I think it has about 80 different industries in there at the moment, and it will highlight what the most material items are within each of those. So, for example, in professional services, which obviously Mazars is, it has data security, ethics, diversity, and inclusion as some of the core topics. As Emmanuel has said, everybody really has climate as a material item, but it's what you build on top of that that matters. So there's a number of I suppose, third-party organizations that can provide us with some sort of benchmarking material, which is relevant. We also then need to go out and talk to stakeholder groups. So that would be staff, shareholders, investors, key suppliers and key clients. And really, we generally start with staff groups who can represent these individuals, and then we go out and have further conversations with the individuals. There is an opportunity to use some survey type techniques. We found limited ability to use what we get back in the surveys in order to be able to provide the level of assurance that's needed in order to satisfy the auditors. So at the moment, we're doing more actual direct engagement, workshop, documentation review, and then using survey tools more as a validation exercise as opposed to actually coming forward with everything. Another point actually that Laura made earlier on was that we're currently at the first set of the ESRS, which are the global set, and we will get into industry-specific ESRS, and we'll also, ultimately, you can get into company-specific ESRS. And so while we're at the point right now where we don't have the industry specific ones, and they may not be here for a little bit of time, the ESRS, we don't take it that they are the total potential requirements, right? So there's 82 disclosures within the ESRS, but when we're doing the materiality assessment, we step back and we go, let's take this from the bottom up. Is there anything else that's very specific to our organization, to our industry, which isn't yet built into the ESRS? And then, take it up from that point and decide if it's material. So with the materiality, we find it's probably 50% of the effort that we apply in phase one of these projects right now. And it involves all of that and takes a significant amount of time in order to get it right, and in order to get the reporting to a level, or the analysis to a level that's going to satisfy auditors like ourselves or other auditors in the future. Emmanuel, just maybe with regard to some of the challenges, do you want to say a few words on data?
Sure. Well, I want to be very short because I want to leave time, of course, for questions later on and interactions maybe with those listening to us. But one thing that needs to be clear to everybody is that there is a real challenge with the ESG data compared to what we know about the financial data, for instance. One, it's very much unstructured and unstandardized. We're not talking always about euros and dollars, for instance. We're talking about liters of water and then kilowatts of energy, electricity, and that's a little tricky. The second thing, which is quite important in terms of ESG data that we need to keep in mind, is that with regards to CSRD, there is a historical reporting that needs to be done, but there is also a very large portion that is about prospective information. I've been talking about the transition plan. There are other examples in the ESRS that require prospective information. And that's something that's a little tricky and that companies are not necessarily used to do all the time. There are plenty of those elements, and that's why in our last C-suite barometer, data quality was identified as one of the main challenges for ESG reporting, and data tracking as well, obviously. And that's something that we are really keen on helping our clients to make sure that they have controls around that and that they know what they are talking about. This last point is important, that they know what they are talking about. Too often, what we realize is that people don't really understand and can't really rationalize the information that they disclose in the ESG reporting. Too often, we have seen clients reporting numbers with 3 zeros in terms of number of liters of water consumption, for instance, 3 zeros more than was the actuals, and nobody noticed because people are not used to consider whether this is 1 million liters of water that is a water consumption or if it's 10 million liters. You are used to know if the net result is 10 million euros or 2 million euros, but you don't know exactly what is the water consumption, and you don't have the benchmarks, you don't have the referential. So that's something that's really is critical to understand, that the data is different and that it's really a challenge to extract and aggregate that data in a way that can be controlled by the central functions of the companies. If we move to the next slide, and that would be maybe the right way to finish that presentation, is also to remind people that with the CSRD, it's a very strong strategic exercise, but that's also a communication exercise, which is something that people subject or companies subject to NFRD are used to, because the NFRD was really started as being a communication exercise in many ways. But here, that's really becoming a strategic communication issue, because greenwashing is in the mouth of everybody. And there are plenty of risks that are coming with the CSRD disclosures, plenty of new responsibilities that will be coming also for the audit committee, for the board, and also for the company itself. There are more and more information that are out there about ESG, and more cases of litigations on ESG greenwashing. So that's really something that needs to be dealt with carefully, because typically for listed companies as well, ESMA, which is the European Association of Market Regulators, just published CSRD and ESG reporting and one of the top priorities to make sure that it's correct. So I can only urge our clients to adopt a very cautious and compliant approach to ESG reporting, to make sure typically that the company is not taking too much risk by being overly optimistic maybe about its own ESG footprint. So that's really a balance that needs to be found for each company, to make sure that they are not taking additional risk through this ESG publication.
Thank you, Emmanuel. So I think Laura maybe will just finish off with a little bit on auditing and assurance levels.
Yeah, thanks, Liam. So I was referring earlier to the CSRD being a game changer with regard to sustainability reporting. This is also very true with regard to the assurance requirement that will now be in place. So in Ireland, until now, there was no assurance required for entities subject to mandatory sustainability reporting under NFRD. This is something completely new that is brought in by the CSRD. So the requirement during the implementation phase, and when I say implementation phase, I'm referring to 2025 to 2029 for the 4 groups to come into scope. The entities will be required to obtain limited assurance on their sustainability reporting. It is then expected that the limited assurance will be replaced by reasonable assurance at some point. Indication at the moment are referring to reporting in 2030, so in 2029 data. That's the initial timeline, but is yet to be confirmed. So we'll see when that transition, but the intention is there. And this is important to know from the beginning, because from day one in the project, knowing that it will move to a reasonable assurance, that allows us to get ready from the beginning and don't have to do this kind of catch up or amendments at a later date. Briefly to touch on the difference between the 2 levels of assurance. Limited assurance is when a practitioner will include in their conclusion a negative sense. So based on the procedures performed, nothing came to our attention. Whereas under reasonable assurance, and reasonable assurance, it was what we do on statutory audit, it's a positive conclusion that it's provided. So the financial statements give a true and fair view of the financial position of the company. So you can see that the extent of procedures required and the audit effort will be broader under reasonable assurance versus limited assurance in the first place. So a third party, an auditor, will have to be engaged by organizations in order to review their sustainability report. And that can be the statutory auditor that is already engaged to do the financial statement audit. Just to finish, and then we'll move on to the Q&A. I just wanted, and I'm putting my auditor's cap on there, I wanted to share 2 comments, 2 recommendations with you on the assurance topic. The first one is the importance to consider from day one of the CSRD readiness project in your organization, the limited reasonable assurance review that will be performed. So this is to ensure that from the beginning, you have a proper audit trail that is kept, that the work performed, the analysis you run, the various aspects that have been considered are all documented, that the decisions, the conclusion reached are supported. So if you think about the double materiality assessment that we've discussed previously, the degree of judgment, of interpretation is high. Is the topic material? If not, what led me to that conclusion? Should I consult with this type of stakeholders? How have I decided that? All of that, it's very critical to have from the beginning a very clear audit trail and supporting evidence that can ultimately be provided to the assurance provider so they can review and corroborate your conclusions and then ultimately your green disclosures. The second point, that it could be beneficial to engage early with your anticipated assurance provider, even if that's only going to be in 2026 or 2027 for you. We have to remember that CSRD assurance is new for everyone. And by having this early engagement, you can ensure that you get the inputs and the views from the party who will be ultimately assessing your disclosures. So getting an understanding of their expectation in terms of assessment, documentation, governance, all of that can prevent surprises at a later stage, but most importantly can prevent having to revisit certain aspects or to go back and document again things that you've done in the past. So I'll stop here. These were kind of the key points we wanted to share with you. Thank you very much for joining us today on that. And Liam, I'll hand over to you. And I think we have received some interesting questions.
Yeah, we've quite a number of questions, so I might try and bundle them together. I'll maybe take one and then I'll ask Emmanuel the next one. So we've had a couple of questions around timing, and I think Emmanuel said, you're looking at probably 12 weeks-ish to do phase one, and then you're looking at a year to 18 months or maybe longer technology implications, to deliver the project. I think the key thing we're finding is that organizations are being asked questions they haven't seriously considered in the past. And so it's one thing to be able to get to the point that you can actually deliver a report which your auditors will stand over. It's another thing for you to be proud of what that report says and not to be racing at the last minute to try and control the narrative around negative reporting. So I think what we're seeing is most organizations, well, I would say the vast majority of organizations that are going to be reporting at the end of 2024 are already well through their project. We are seeing stragglers at this point, but they are challenged in the sense that if they need to capture data from the start of 2024, they're not going to be able to do so if they're not already delivering their project. Now, that's not to say we aren't still being asked to tender for projects even now for 2024 year end, but really we've probably seen since September organizations that are really in the 2025 year end start to engage more effectively on this. So I think we're probably looking at 18 months to 2.5 years really to get on top of all of this. Emmanuel, a question for you, which is probably, there's a couple of questions. There's one question which is very specific around the role of enterprise risk management in the entire process, but maybe you can put it in the context of ownership and of the implementation and the delivery of CSRD more generally. If there's an enterprise risk management link, please put it in. You're on mute there.
Sorry, apologies. Yes, well, that's quite important to include the ERM approach in the materiality assessment phase, for instance, because typically what many companies have been doing in the past, they were reporting on risk mapping and including ESG kind of risk that they were disclosing about. And that's very consistent with the approach that needs to be followed for the materiality assessment. And typically those risk mapping could be, in many cases, the basis or the feeding the materiality assessment. So enterprise risk management is really part of the resources that we are going to be included in the materiality assessment process.
Thank you. And then more generally on ownership of sustainability, the entire process.
So on the ownership, what we observe is that if we look at the NFRD reports, very often it was owned by the ESG department of the company. Of large companies, they all have ESG departments and so on and so forth. Now, we do a lot of calls, presentations, and projects on CSRD readiness for clients. Almost all of them, in all of them, we have the finance department involved. And in most of them, we have the lead of the project that has moved from the ESG department to the finance department, and which is basically turning things in the right order in my mind, because that's really looking at CSRD as being a transparency reporting exercise. And the finance department is used to the tricks of reporting, sometimes more than the ESG department. And that is really putting back the ESG department at the core of what it should be, which is basically working on the strategy and at making sure that the company is on the long run sustainable. So we are seeing, again, a realignment of the roles and responsibilities of the various departments within the companies, with finance taking the role for reporting and the ESG department taking the lead for the operations and the ESG strategy.
Thank you. Laura, maybe if I bundle a couple of questions here together. So one is around exemptions with regard to the ESRS and the transitional requirements, but then there's a second question around EFRAG announcement in October around the delayed release of the standards, and does that have any impact on what should be done now?
Yeah. So I suppose to start maybe with the exemptions, the short answer is yes. Embedded within the ESRS are a number of transitional provisions. So not to go into the level of detail, but 3 categories. The first one, which is very important, is the fact that there is no requirement for disclosures of comparative information in the first year. So basically, first report, you provide the information for the current year, and then coming to the second one, you bring in the prior year in. So there's no exercise to do on comparative in the first year. The second one is a 3-year delay for collecting information around the value chain that is allowed. Now, this is on the principle of comply or explain. So a requirement is there to comply with the disclosures requirement, but if it's not possible because of the complexity or the time needed to gather all the right information, you have this 3-year period. Though for elements that are not complied with and not disclosed, you will have to show in your report why information is not available, the plan for remediating, and the timeline for the remediation. So it's not that you can leave aside certain elements. You still have to have a plan in place to know how to get there in terms of the disclosures. And then the third group, certain specific disclosures related to entities, so entity-specific disclosures will be subject to exemptions and have a sort of a phased-in approach that certain elements we need to disclose from year 1, certain elements are tagged as being required only from year 2. And then maybe a quick word on the second question. So the sector-specific standards will bring a more structured framework in terms of what expected from each of the sectors. But still, as part of your assessment under the set 1 standards, and this is coming from the ESRS 2, you still have to consider the material sustainability matters for your entity. So from that, an element of sector-specific aspects relevant to you will be captured. So what the sector-specific standards will bring up is a more structured, aligned, making sure that there's better comparability within the organization. But still, an element of sector-specific information will be captured naturally as part of the assessment that you do.
Thank you, Laura. We have a number of very specific questions about scoping, going from NGOs to charities to UK companies to international groups. And I would say to individuals that maybe if they want to, everybody wants us to tell them the answer to their particular situation. So if you want to email us, we can do that afterwards individually, as opposed to try and address your specific situation and then say, well, we don't really know if this applies to you because you haven't given us the detail. So if you do want to know the answer to that, you can email us afterwards. There's a couple of questions around, I suppose, systems. So, how are we going to capture the data and gather the data? And certainly, yeah, we think, we certainly in Mazars have a global system that we use for our CSRD preparedness, which will have, climate module, a social module, an ethical module. So there is, you're going to need to start to consolidate this data in using spreadsheets to, for example, report your carbon emissions, and being able to stand over that from an insurance perspective is very difficult. So more and more we are seeing systems being put into place, which obviously that draws out the time required to deliver these projects. I don't know, Emmanuel, did you want to jump in?
No, to your point, actually, we've done, there are a number of new systems, new editors who are putting out ESG reporting systems that claim to be aligned with CSRD. So that's a good thing. It's not the right solution for everyone, depending on the size and complexity of the information of the organization. But what we've done at Mazars, our global team, the CSRD task force, has already reviewed 200 of the softwares, ESG reporting softwares that are out there in Europe, and has rated them. So we have done already this kind of work of reviewing 200 of those systems, and we've been able to rank them depending on what is the objectives, and find a way as well for our clients to match their requirements. So we've been working quite a lot on this ESG reporting systems. We are not recommending specifically one of those systems, but we have a view on how those systems could fit with the specific requirements of each company.
Thanks, Emmanuel. Probably just one last question, just around greenhouse gas reporting, and is there standards within it? No, you would use the greenhouse gas protocol, and you would apply the same sort of scope and boundaries as would apply in the greenhouse gas protocol to do that.
Yeah, this is actually the recommendation or the guidance that is being issued by in ESRS E1. Is basically to look at the greenhouse gas protocol.
Yes. So unfortunately, we've come to the end of our time, and we have a large number of additional questions. So I would say many of them are from anonymous attendees, where people have included their name. We'll go back to them. We have your email address from the registration. If you have the anonymous attendees, if you want to submit your question to myself or any of the other team members, you could do so. These slides will be circulated, and I think our email addresses are included here in the last page. So again, thanks so much for, we have a very large crowd here today. We're delighted to have so many people engaged. We appreciate you coming along, and thank you very much, and have a great day. Bye now.
Bye-bye.